Good day, everyone. I'm Prakash Venkat. Canadian market update. Mainly the theme revolves around two asset classes in three cities. The transaction market has been slow overall due to the economic uncertainties, as mentioned by Ross. We are facing the same thing in Canada, and the Canadian investors are more inclined in investing outside of Canada. The NAV seems to be holding up for majority of the portfolios, and there seems to be a significant disconnect between public and private market valuation. This thing has been continued for a while now in Canada. The hybrid workforce model is being firmed up, and many Canadian companies want their employees to be back in the office at least 2 to 3 times a week. By the way, Kroll needs his employees 3 times a week. That's our policy. And the office assets are, the cap rates are expanding 50 to 100 basis points, but the revenue growth is also happening at the same time. More short-term leases are being signed in the office segment. Better quality assets are doing well as compared to the other assets. The retail market recovery is happening slowly, and essential services continue to do well. And they're also expanding their GLAs in Canada. The multifamily rental apartments are the best option as the housing prices soar significantly. Student housing is another hot asset class. Given the increase in enrollments, it's extremely tough to find accommodations for students. And some of the markets have 0% vacancy for students' housing. Let's just shift gears and talk about specific asset classes. Let's talk about industrial market asset class. Industrial market assets have been, there's been imbalance, mainly due to inflation and increase in cost. Industrial properties continue to outperform. They have the lowest vacancy, approximately 1% nationally, significant rental growth, 15% nationally year over year. Average rent for industrial properties in Canada is hovering around $14.75. Just as a comparison, pre-pandemic, the rents were $6 per square foot. Recently, we're seeing more and more short-term leases for industrial properties as the landlords are trying to capitalize and leverage the higher rental growth on the current market rents. Average cap rates are between 4.75% to 5%, which as compared to pre-pandemic, it's 5 to 6% before. A very similar story for multifamily. Most resilient asset class in Canada. The vacancy rates have been stable through 2017 until now, and it's around 1 to 2% nationally. Rents have gone up steadily from $1.60 per square foot to $2.20 per square foot. Average cap rates are 3.5% to 4.3%. Some of the valuation topics are our clients are interested and market participants are interested in knowing are TOD, transit-oriented development, intensification of downtown, densification of retail, alternate use for retail, converting these retail non-performing assets, and wealth transfer to the next generation. If you're interested in any of these topics, please reach out to one of the team members. The Canadian sales, going by the trend in the previous slide, as you can see, the Canadian sales volume are directly supporting some of the comments from the previous slide. Industrial and multifamily leads the way here. We'll talk about the key markets. Toronto being one of the key markets, the highest sales volume in Canada. Unfortunately, due to economic uncertainty, the rate of growth has been slower the last couple of years. Average retail cap rates we've seen remained unchanged at 5.75%. Industrial cap rates have seen compression during the pandemic, and it is trending upwards right now. Office cap rates have seen expansion and will continue for a while. Multifamily, the most resilient asset class, cap rates and vacancy rates have been fairly stable, and the cap rates have been at 3.8% in average for Toronto. Vacancy rates are stabilizing for office and retail. And for hotel properties, the ADR, the average daily revenue, are bouncing back, but the occupancy is still lagging behind the pre-pandemic. Short-term leases for office and industrial, and for opposite reasons. For office, short-term leases because of the tenants, they don't want to commit for long. For industrial, due to the landlords trying to capitalize on the increase in rental rates year over year. Let's talk about the second market, which is Vancouver. Vancouver is a relatively smaller market compared to Toronto. Demand for office, industrial, and multifamily continues to be strong. Cap rates across asset classes are trending upwards in Vancouver. Industrial rents are one of the highest in Vancouver, which is $20 per square foot. I'll switch to Montreal. Montreal office market vacancy is trending upwards and rents trending downwards. Cap rates are trending upwards for most asset classes in Montreal. Industrial assets with rental upside continue to be the top targets for the Montreal market. Relative to Toronto and Vancouver, Montreal assets are a bargain. That completes my Canadian market update. Any more information, anyone interested, please reach out to us. We're happy to share more.